So Mind Finance panel, we got successful alternative financing solutions and their growing adoption, and we're delighted to welcome a fantastic lineup for you. Joining me on the stage here, we have Kevin Flynn, who is the CFO of Anglo Pacific. We have Brett Heath, President and CEO at Metalla Royalty and Streaming. We have David Awram, who is the Senior Executive Vice President at Sandstorm Gold, and Philip Clegg, who is a Portfolio Manager at Orion Resource Partners. So thank you very much. Let's have a little round of applause for our panelists to get us, welcome them to the stage. You'll have a chance to ask questions to our panel, so do please think of your questions. But I've got some questions. First of all, why does the industry need you guys? Alternative finance. What's wrong with just going to your stockbroker and getting them to raise the money on the capital markets?
Okay, well, I'll kick it off. Listen, maybe I'll talk for the next half hour about this first question all on my own. I mean, there's no surprise. This market, for the last, well, call it since 2012, has really been starved of capital. And also, looking at us as alternative finance, it's becoming less and less alternative finance. It's more of a point of really becoming a fundamental part of your capital structure going forward on trying to build a project, finance your mine. Debt is risky. Equity can be extraordinarily costly for you. I think the market has really come around to the fact that this industry just gobbles up lots and lots of capital. And you need to make sure that you have good partners that are aligned with you, that are really this quasi-equity type of finance going forward. That's really going to help you develop your mine and drive value for yourself going forward. It's also important to make sure that you have partners that are making sure that they can help provide you equity, or at least help drive equity towards your story going forward as well too. So I think that's, in a nutshell, why you need that alternative financing, and these types of products have emerged quite a bit more. And also because a reason why they've developed so well and been utilized so often by all levels of company in the whole spectrum, not just explorers, not just single asset developers, but through that whole range of companies that are there. I guess in the end, it really just means like how much capital has fled from our industry. You need to come up with new ways of thinking about how to provide that to make sure that your company can sustain growth.
Philip, is this the new normal?
Well, that's it, isn't it? I mean, alternative finance is really quite mainstream now, particularly for development companies and construction finance situations. The point I was going to make is that, just to add to that, is that equity markets are still really quite tough. We've just seen a new wave of redundancies here in London. We've seen them elsewhere as well. The debt market, the traditional debt market, is also pretty tough, particularly for development finance situations. And so, if you're going to be successful, you have to have a really high-quality asset, high-quality management team, and then it's still going to be difficult because you need to pick and choose each aspect of the cap structure in order to build a mine. So one of the sort of the secrets behind the Orion's success has been being able to provide a holistic solution. So it's a one-stop shop. You can come to someone like Orion, and we would be able to basically tailor the financing solution for the counterpart, and they can basically pick a bit of debt, stream, offtake, royalty, equity to provide an overall solution for, say, 80% of the capital that's required. And so that tailored financing solution that provides nearly all the capital that's required is one of the secrets behind Orion's success.
How early in the process can you get involved with the company?
Well, we have two main strategies. The first is the construction finance, and that really is the bread and butter of Orion. But we also have a strategy which is M&A finance, and those are for producing companies. So really, most of the deals we do are construction finance and producing assets. But there are occasions where there's a high-quality team and a high-quality asset where we can get involved earlier, sometimes as early as the PEA stage, but normally it would be post-pre-fees, and when we've got a good visibility over the quality of the asset, but on top of that also permitting, because ESG is incredibly important to us.
Would you ever consider setting up something that was more targeted at the sort of exploration end of industry?
That's not, I mean, never say never. I mean, Orion is a growing organisation, but, in terms of the skill set that we have today, that wouldn't be something that we would be involved in.
Right.
Yeah, I mean, I think going to, Philip's point about picking the right projects, I think part of the problem is there's just not the quality of projects out there today as there were 10 years ago. There's not the projects out there that have that margin that can support the debt or streams or royalties. And so, what's happened is that you've had kind of this, this digression of really kind of good quality projects in the rest. And the rest continues to struggle year after year, staying afloat, hoping for a high gold price. And so, I don't know if that's a function of kind of more of a macro type of, we haven't found, or no one's really finding these good quality projects anymore, but there's a lot less than there were 10 years ago, and there's a lot less than there were 20 years ago.
Why is this? Just because everything good's been found already?
I don't know. I mean, there was a lot of capital that came into the exploration sector in the last peak, 2010, 2011. And the amount of capital that came into the sector compared to how many discoveries of what you've seen in the previous cycles was a fraction of what was there. And for the big companies are looking for, the major mining companies are looking for projects with at least 3 million ounces of gold. And if you look around today, the ones that are here, you probably saw them 10 years ago, and they're still here. So it's going to be an issue, and it's going to be a big issue for the big companies going forward in order to find these things. And I think that's where the alternative finance industry, like the royalty companies, the private groups, can really kind of pick off and help the big projects along. But it's going to be tough for a lot of the sector.
Sorry, I don't mean to jump in there. I don't know if I entirely agree that the projects are worse off. I think maybe some of the easier projects have been taken, but I think those were projects that really kind of happened in the 60s and in the 70s maybe. I think what's happened is that, because honestly, we've had lots of crappy projects that have been around for decades and decades in this industry. I think what's happened is that there's been a lack of, financing projects, let's call it 2 decades ago or 3 decades ago, really kind of followed a different pathway than it does today. And I think part of that is overall structural change in really how capital makes it into these projects. And I think how investors look at investing into these projects. I think there was maybe less control, less awareness, less overall, I think, sophistication on the financing side that has happened prior to really now. And I think that money, and that institutional money in particular, has found really better homes and more effective homes to determine what's really kind of a successful capital structure and what isn't. I think that's why we've seen this emergence overall of the entire industry of much more private equity type of investment, because there's been overall frustration with the lack of performance on the equity side and the lack of reliance on the equity side, and really kind of flowing into something which has got a little bit more sophisticated way of approaching financing issues in the industry. So sure, there's I think the struggle has been in the last 10 years, it's not so much a quality of the asset, but just the inability to really figure out that proper financing mechanism and that capital allocation blend within a project that needs to go forward or is trying to go forward.
Yeah, I think I'd echo a lot of what's been said already. Anglo-Pacific looks at this really from a London and a non-precious metal side of things, and what we see is quite similar across the piece as well. The capital markets are very, very tough, certainly on the equity side, and I think where alternative financing comes in and plays a part here is that it is a partnership. It's money that goes in that's not looking to trade out. So we very much like to see ourselves as permanently invested in the projects. Which is why we probably only do a couple of these a year, because we look at a lot, but we consider our returns over the life of the mine. I'd echo what Philip said. I think a key component of what we look at now has to be tailored around the ESG side, the credentials, of that. We're a public company as well, and most of our stakeholders will be looking at this through the assets that we invest in. But certainly for looking at alternative financing becoming more mainstream, I think what's very obvious to us as we've looked at a number of projects over the course of the last 24 months is that a lot of companies that we see now, their advisors very much see alternative financing as part of the overall capital structure of their companies. So it's no longer a unique piece of any mining company's capital structure. It's more understood. And, you know, in the past, I suppose it would have been perceived to be expensive or restrictive financing. And in actual fact, it can be quite flexible. Similar to what Philip said, it can be structured in a way that suits anybody's capital structure, whether they have debt or a high level of management investment in the project itself. And for that reason, what we've seen when we support a project, certainly probably pre the main financing of the overall operation, is that Anglo Pacific coming in at an early stage can provide an endorsement for the equity story. And we've seen that in a number of examples.
Just to add to that, if I may, sometimes when people think about alternative finance and they're constructing their project, they're thinking, I'm either going to go down the traditional route or I'm going to go down the alternative route. And it doesn't work like that. Sometimes they're mixed together. And so in those higher quality assets and higher quality management teams, you can have a situation where, you know, these companies can access traditional debt. And to do that is fantastic. But it doesn't mean to say we can't get involved. You know, we can get involved. Lundin Gold is a fantastic example. It's worked beautifully. And it's a combination of traditional debt finance from many European banks, together with a stream plus gold loan from ourselves and our JV partner Blackstone TACOps, and then equity from ourselves and Blackstone together with the public markets. We can do that. And actually, you know, the four people you see here will work together as well in combination on all sorts of different stories, producing or construction. So it's not like you have to pick and choose either or. It's about partnership, just like you say, you know, and we can partner with both traditional forms of finance and with each other.
Because you don't want to shut the door for future financing. Because you do sometimes hear about companies where they've got a stream or something that makes future investors think, well, maybe I won't invest in that company because all the upside's already been sort of taken by someone. Well,
that whole stream, I mean, in the end, the stream being used as a financing mechanism, don't forget, it's only 15 years old. And I was involved in really the creation of some of the very first ones. And we made mistakes. There was a lot of weird ways about how it was created. So since that time, it's evolved quite a bit. And Sandstorm has really been active in that because we've done so many of these types of transactions. But that's one of the things you have to make sure. When we're investing in something, what we're purchasing is a very, very long-term interest in this. There is no liquidity in this piece afterwards. We can't sell at a high market. We can't exit when things are going bad for the company. So as an industry, the way streams have evolved, you've taken that perspective of, okay, you don't want to jeopardize this ability of this company to access equity today, and you want to make sure that there's encouragement for future equity that's not even there. Because if you don't do that, if you don't leave them with enough economics in that project for your project to attract that future equity, it's just not going to work out. You're going to have to restructure this, you're going to do it, and in the end, you know, nobody wants to be in the business really kind of financing distressed assets. You're not going to get anywhere. You're spending all your time restructuring that rather than anything else. And if you look at the latest deals and transactions that have worked that way, it's worked out great for existing equity holders. Our last deal with Americas Silver, their equity now is worth more than twice as much. They've been one of the best performers in 2019 as a result of putting together what was a good comprehensive deal, but still made sure that a lot of that value and the bulk of the economics and the future upside of the project remained with it. So it really is a completely outdated notion to believe that a stream or royalty type of financing is going to impair your ability to attract future shareholders.
Yeah, I think that that's true, and I think that for whatever reason, historically or otherwise, the sort of royalty and streaming models had a bad reputation. It's actually completely incorrect. It works well when correctly structured amongst other parts of the capital structure. What's important to remember in that is that the royalties and streams, they are a lower cost of capital than the real alternative, which is equity. They only get access to whatever you structure contractually that stream to, and that typically is going to be your primary asset. If you issue equity, you're giving away part of your entire company and whatever your company ever does, any project you buy, any project you build. And so actually overall it's quite a neat form of financing.
Let's talk about some of the specifics of some of your deals. Kevin, what sort of, the two gentlemen in the middle invest in precious metals, I guess, but you don't, do you? You do sort of base and other things. So tell us about what you invest in.
Yeah, we do. We look at all commodities. We've kind of strategically decided to leave these gentlemen to the precious metal side of things. But what we figured out a couple of years ago was that the overall royalty industry or streaming industry is worth about $20 billion at market cap. But precious metals is only about 20% of the overall mining industry by value. So that leaves a huge section of the overall sector without a specific listed royalty company. I know Orion look at this too. So we look at all things. But I think, touching on something Philip said, I think the royalty piece for a large bulk project is never going to provide 100% of the finance required to bring that through. So it's vital that the royalty product is structured in such a way that allows for that equity to come through post signing of the royalty deal. The royalty can support the DFSs or the study stages, and that's where it can work quite nicely. But the transactions that we look cover multi-jurisdiction, cover multi-commodity, but ultimately, these projects have to have good management teams, a clear vision, good ESG credentials, and we have to take a view that it's a good entry point into the commodity as well.
You mentioned obviously ESG there, and you're getting more pressure, I guess, from your investors to focus on that. Is that going to limit your choice of commodities you can go into in future?
I mean, possibly. I think it would be very difficult for a public company to do anything with coal at the moment. We're seeing that in many areas, and that's maybe something that is better suited to a private equity vehicle, for instance. But it's not just commodity. It's how it's where the project is located. It's about the social license to operate. It's about how that mining process is run. And we spend a lot of time looking at that with our technical consultants when we go to site, and we take our own view on that. Because ultimately, royalty companies, streaming companies have our own shareholders too. We periodically need to raise our own equity, and our assets need to be of sufficient quality for us to be able to do that.
If I may, just from a private equity firm, ESG is actually top of the list. Just to be absolutely clear, it's hugely important to us. To the extent we just appointed Robin Weissman, who actually wrote the Equator Principles for the World Bank to our investment committee. So it is actually number one on the list. If you get that wrong in any project globally, then it's going to fail, and that's something that we wholly recognise.
Well, yeah, I mean, maybe it's become more top of mind, I think, for investors today, and maybe on the institutional side. But the same thing, for the last 20 years, if you're a mining company, if you're not paying attention about how your project is going to affect the local communities and affect the local, really the environment that sits there, then you're really not going to get anywhere. You take a look at the companies that have failed at their ESG programs and failed to really properly consult with the communities and in the jurisdictions they're in, those projects don't go anywhere. So it's always been at that top of the list because it's not just creating something that's a requirement so that the institutional investors can get the right rating for you. It's a problem of really understanding what the timing for this project to get into production is, and that's critical.
And I think that's right, and I mean that's kind of one of the main reasons. Not just that, but among other things, just the ability to get into quality projects. Metallo being the smallest royalty company, or one of the smallest royalty companies, we don't have the benefit today to be able to write, $100 or $200 or $300 million check that often will get you into that type of quality asset, quality operator that has those high standards. And so we've taken a different approach and really focused on the existing market and starting there to be able to scale our business, because in the existing market, it's unique today, but it's really how some of the bigger royalty companies built their business back in the 80s. But what it allows us to do is to lever into much stronger counterparties. And a lot of these larger major mining companies don't even finance. They don't even need royalty or streaming finance anymore. So it really kind of allows us to set a solid base to be able to grow on. And as we continue to grow our business, then at some point, we'll be in a position to be able to look at providing capital at some of the stronger counterparties out there.
When did the company start, and what sort of checks can you write?
Well, right now we started in September 2016, and we've grown our portfolio from 0 to 45 assets. And we've completed about 15 transactions during that time. And that's really been a focus of being able to navigate this existing market in a part that I would say is maybe a little bit less of an attraction for some of the bigger companies, just because the transaction size is a bit smaller. So it allows us to really kind of get in there and grow. But we have access to capital now. Being able to grow and scale the business, has given us, and as we continue to grow, we'll be able to look at bigger things. And to what Philip said before, we oftentimes talk amongst each other, and we look at deals together, and sometimes be bigger part of other types of transactions.
Do we have any questions from the audience at this stage? Rod in the front here. Question? Microphone? There's a microphone is coming. There we go.
Yeah, I haven't got much time here, but what strikes me as being very relevant is that the royalty class of investments has really grown since the early 1990s, and with Anglo here giving you the base metals, and Sandstorm precious, and Metallo basically precious metals, it's a very different risk concept to investing in projects, which most of us, particularly the front row, have made a living investing in projects. Well, every now and then you get a really big return, but a lot of the time you lose. So what I've looked to royalty companies for is de-risking the investment process, because effectively they have got teams, they've got databases, they've got knowledge capital. But what's really important is the analysis of royalty companies, which very few people yet, particularly stockbrokers, are not yet doing. And I'm very interested in the net asset values of the projects in the pipeline. And the relevant thing from an investor's point of view is how you can participate in high growth without the risk. And I just wonder if the panelists could give an indication of where their net asset value relative to market capitalisation is now, and where they think it'll be in 2 years' time, because that's the horizon at my age that I'm interested in. I'm not interested in 10 years anymore.
And Rod you were an early investor in Franco-Nevada, weren't you?
Yeah, I was a founder investor in Franco, and I've invested, 7 times in royalty companies. Currently, I'm an investor in 5 separate royalty companies, of which only 2 of them are listed. 3 are coming onto the market in the next 3 months, and I think that I believe that the royalty sector is going to be a serious outperformer over the next several years, because they've got the bloody projects that are coming through. And I don't want to be involved in financing a project in Burkina Faso at the moment.
Well, I can talk a little bit about the valuations. Today, and I think for the last several years, royalty companies have been valued really based on existing cash flow. So if you don't have that existing
That's the wrong measure.
Correct. I'm not going to disagree with you, because it's really about an optionality type of story. But that's really what we're faced with. And in the end, the gold market overall is difficult, I think, for any institutional investor to approach right now, because institutional generalists are valued really off the benchmark today, and the benchmark really breaks records every week that we're sitting in. So as a result, there's a lot of reluctancy of that institutional money in the generalist sector to really kind of come into the space. And using those types of metrics like EV to EBITDA or cash flow metrics, that's not correct either, because in the end, the cash flow that we have compared to other companies and even other sectors doesn't really make sense, because in the end, we're not putting capital back into the projects. That cash flow, that operating cash flow, ends up being quite close to ultimately really what the free cash flow of the company and allows
David, what are you relative to NAV? Are you twice NAV?
We're not trading at twice NAV right now, but the other thing that's important, I think, will be relevant when money starts flowing into this industry again, and presumably it will, because equities can't go up forever. But once it starts looking in there, people start valuing that optionality, which of course across our entire industry is getting no value right now at all. But one day it will, and it gets valued in royalty companies much more effectively than any other companies, because you get that incremental upside and then incremental capital for even on those best projects. You know, you take a look at the best projects out here and you look at the optionality that say Chapada has by Lundin Mining. Great project, great exploration. In the end, it's going to cost them a lot to get that upside and access that upside. But for Sandstorm, owning that, we'll get that upside and we'll get that incremental cash flow without any capital going back into it.
What are you in terms of price versus net asset value?
Well, we're trading at just over or just below 1 times NAV, depending on really where you take the gold price.
All right, that's cheap. What about Brett Heath?
I mean, currently we're just slightly above 1 times NAV. But I mean, to your first question, which is, you know, how do we show the growth of NAV? A benefit that we have is, again, focusing on the existing market, is we're able to pick up projects that oftentimes already have that infrastructure there on big mining companies. And so when project capital or when project funding is given to build a mine, the goal is to put the mine into production. And oftentimes there may be lots of upside in those assets, but they're not really focused on adding another 10 years of reserves, where when we're picking up royalties, sometimes on major mining companies, assets that are right next or near existing infrastructure, you know, oftentimes what we've experienced is 50, 100, sometimes even more than that reserve growth year over year, and we'll probably continue to until that part of the asset or that satellite deposit goes into production. So there's a lot of underlying value that can be kind of generated within the existing portfolio, the way that we look at you know, building our portfolio.
And I guess if I can make a bit of a sales pitch here, you know, I look to my left-hand side with a lot of envy at the ratings at which the precious metals companies in Canada can obtain. We at Anglo Pacific, you know, trade on similar levels of cash flow to an Altius, for instance, who get valued by the street at 5% WACC. We're suffering 8 to 10 here. You know, I think what's obvious is that, you know, to close that gap for Anglo Pacific, which we feel we should warrant, you know, scale is important. Size matters for royalty companies. Liquidity matters. And I think what we're doing slowly is we're building our asset base. We're predominantly acquiring income, but we're also selectively investing in, you know, projects with longer lead times to growth that we think will provide a higher NAV growth multiple as those projects get closer. But what we want to see is this business growing. With that growth becomes more liquidity, and with that we hope we'll narrow that discount rate closer to the North Americans, and that in its own right would enable us to really achieve more of a PNAV rating than what we currently suffer from.
Yeah, but one of the problems, though, is that the successful established companies are capped at 1 billion plus. I mean, Franco's now 23 billion with 397 projects. What can make a significant difference to that? Metallo's been going 3 years, it capped at 180 million. The next 4 projects in the pipeline are going to make a colossal difference. It will go to 100 million more. And that's where you get your growth. You don't get your growth from investing in mature companies. You get your growth from getting in at the point where you can evaluate the project pipeline, which is a very detailed due diligence process. And that's what stockbrokers aren't doing yet. There's only 2 brokers that have properly analysed the royalty companies, and none of them have issued a report giving the peer comparisons for the sector. Whereas you can get that for copper, even nickel, or gold. You can't get it for the royalty companies because the brokers can't make the money from royalty companies because they don't need the bloody finance. They've got the growth internally. Sorry, Leo. I'll shut up now.
That's absolutely fine. Rod White, our 5th panellist there. Excellent. Unfortunately, we have actually run out of time there. Yeah, absolutely. But some fantastic insights there from our panel and the 5th Beatle over here. Thank you very much. So can we have a big round of applause? And if you do have any questions, grab them outside.